The end of the consumer carbon price in April drove inflation down sharply, but there are signs of pressure building at the grocery store. Joining me now to break down the latest numbers from Statistics Canada is Moshe Lander, Economics Professor at Concordia University. Good to speak with you.
Hello.
First, I'm curious, what is your take on these numbers? What do they indicate to you?
It's a little bit deceptive. On the surface, it looks like prices are not rising as fast as the last number. And so for people that are worried about inflation, cost of living, affordability issues, this would, on the surface, look like a good sign. But in fact, if you dig a little bit deeper and you strip out gasoline and natural gas, which really fell mostly because of the repeal of the carbon tax, there was actually more inflationary pressure in the most recent numbers than there was a month ago. And so that should be a worrying sign that maybe some of all of that tariff talk and the way it's going to spill over into the Canadian economy is starting to show up.
Apart from that consumer carbon price, are there any other factors contributing to the slowdown we're seeing?
That's mostly it. The oil price has really fallen, and people in Alberta, of course, are very upset about this these days. The slowing global economy because of the U.S. tariffs, not just on Canada, but the escalation that existed until a couple of weeks ago with China and China's retaliation was clearly a sign that the global economy was going to slow down. And so that took a lot out of a variety of things, oil prices being one of them, and so natural gas being affected on the side, and gasoline being a derivative of oil was affected as well. But it's also damaging to consumer confidence, business confidence, and fears of a recession. And so you tend to see then that a little bit of the demand side of the economy dries up. And so that takes some of the inflationary pressure out. But again, if you strip that out, there were other things at play here that suggest that inflation might be a little more aggressive than the headline number suggests.
You know, having said that, then what can we expect to see from these numbers in the coming months?
Well, look, there should be inflationary pressure. I mean, it's impossible to have tariffs there without seeing inflation show up in some quarters. I think the problem that Canadians are having is because we keep hearing the numbers 10% tariffs, 25% tariffs, there's this expectation that inflation is going to be 10% or 25%, and it's not going to be that. It's not even going to necessarily be half that. We won't see 5%, let alone the bigger numbers. And that's mostly because consumers will substitute away from goods that are rising quickly towards goods that are rising less quickly or not rising at all. And so when you adjust the basket then of what the typical consumer is buying, you're not going to see those big numbers, but you will see inflation. Some of the Buy Canadian movement, while admirable as a patriotic duty, is assuming that Canadian producers have an unlimited capacity to meet all of those customers that are showing up. If they don't have that capacity, that could become inflationary. So I think that we're going to continue to see that these numbers maybe not trend up, certainly not go to the level we saw in 2022, but I think that the Bank of Canada is going to have a little bit of a tougher decision in a couple of weeks than what we were thinking they were going to have if we just look at the 1.7% in isolation.
You know, speaking of the Bank of Canada, we're about 2 weeks out from that announcement. What do you think is going to happen? What could this all mean?
Well, if they just look at the 1.7% number, then they would probably cut interest rates. But the Bank of Canada looks at much more nuance than just one number. They look at a wide range of things. I think that their best decision at this point is to punt and just say, you know what, we're going to hold rates where they are. We want to get more data. We want to see how the second quarter for GDP numbers look like, get another labor force picture as to what's happening to unemployment. They will meet in July, and so they do have the ability to cut interest rates then if they want. At this point, a quarter percentage point cut, whether it comes in early June or mid-July, is not going to be the thing that saves the economy or destroys the economy. So more data is always valuable. And at this point, I think because it's a bit of a mixed message that we're seeing in this inflation number, wait and see is the best approach.
Well, Moshe, it's always great to get your take on these things. Thanks so much for taking time to speak with us.
Thank you.